Well, let's welcome in Pankaj Tibrewal. He's founder and CIO at Ikigai Asset Managers. Pankaj, good morning. Great to have you with us here. Thank you for your time. So we are in a bit of a firm downdrift. You've been cautious for a while, Pankaj. Now, the point is earnings are coming in, but markets had kind of written off second quarter earnings. They were looking at H2, third quarter, fourth quarter were recoveries. But is there a sense that maybe this festive season, which is an important part of 3Q, that perhaps is coming a little soft? We got an indication from Bajaj, for example, yesterday. What are you picking up?
Good morning, Prashant. What we have been saying is that earnings growth is slowing down, and partly to do with the high-frequency indicators which we have been tracking. The government has slowed down spending considerably. And if we look at the first 5 months till the data is available, the capex expenditure is down by 20%. And if government wants to achieve that 11 lakh crore kind of a budgeted number, incrementally they need to spend 1,25,000 crores every month, which seems to be a little tall task. And hence you are seeing some kind of a slowdown. And we have been a little careful saying that the earnings growth momentum, last year we saw 30% earnings growth for the broader market, should come down more towards 10 to 12%. The way the earnings season has started right now, looks like the Nifty earning growth should not be more than 9 to 10% for the whole of FY25. On the festive season, yes, what your comment was that it started on a softer note. We have seen different pockets, behaving very differently. On two-wheelers, though the commentary by Bajaj was a little tepid, but the registration data which we saw is not that bad. Registration data is still showing some growth, maybe lower than the expectation what the market was, penciling it at. On the consumer durables, ACs have been quite okay, though there have been some softness in other categories. So we believe that overall earnings momentum has started to slow down. And Prashant, if you remember what we discussed in our newsletter, is that whenever earnings growth slows down, the rally in the market becomes narrower. And we have seen in the past that, it's very important then from a bottom-up stock picking perspective. And we believe that the easy money, which we saw in the markets for the last 3 years, is behind us. Markets will become more and more selective as you move ahead in the next 12 to 18 months. And here, portfolio construction and stock selection will play a very important role in generation of alpha. So my sense is that one needs to be a little careful on the names one is owning in the portfolio, and companies which can deliver 15-20% earnings growth will again become darlings of the market as you move ahead.
Pankaj, hi, morning. So which are the sectors, stocks, themes where we are likely to see the biggest earnings downgrades or cuts versus expectation? And are you lightening your position in those?
So if you look at in the first half, the major sectors which have been dragged for the overall earnings growth is metals, oil marketing companies, energy as a sector entirely in terms of upstream, downstream, cement. So most of those sectors have led to a large bit of disappointment. And if you look at the start of the earnings season, clearly 4 or 5 companies are leading to a bit of a downward revision. First is the steel companies, both Tata Steel, JSW, and then Reliance and ONGC, which are leading to a bit of a downward revision on the heavyweights. But broadly speaking, I think earnings moderation is clearly on its way. And across sectors, we are seeing that the estimates are on the higher side, and we need to be a little careful on the broader market. Though, compared to Nifty, I believe that mid and small caps can offer better earnings growth as you move ahead. But overall momentum, which we saw for the last 5 years, where Nifty 500 companies compounded their earnings at 22%, probably may not be repeating this year and next year. So in that case, the breadth will become narrower and the style change is definitely happening. For the last 4 or 5 months, if you look at value, momentum, high beta, they have all taken a backseat, and low volatility growth and quality has made a comeback, and that is visible from the indices. Also, look at the dispersion within sectors. Defense index is down by 18% in the last 3 months, whereas the healthcare index is up by 14%. And similarly, if you look at the financial services index, it's in green. The consumption index is in the green. So I think broadly, dispersions are very high. And there, if you are good at stock picking from a bottom-up perspective, because the breadth is becoming narrower, the portfolio should reflect that.
Hi, Pankaj. Good morning, and always good to see you. And Pankaj, you have been sounding cautious. You have been warning us every time on the channel as well. Earnings needs to show up. And in the last 48 hours or so, there's been a lot of concern on all the earnings that have come out, across sectors, whether it's wire and cables, whether it's some of these tech-related names as well. Pankaj, but you briefly mentioned that there will be select companies that will grow that 10, 15, 20%, and they'll be the darlings. Our viewers would like to know, where do we find those darlings? If you could give us a sense, which sector could it probably come from?
So, Nigel, we are debating within the team, but the broader thought is that our belief is that consumption may make a comeback. And the thought is as follows. If you look at the last 4 or 5 years, government expenditure was about 3.5 lakh crores. It's moved to about 11.5 lakh crores. And a large part of that spending was across sectors like defense, roads, railways, and so on and so forth. The question is this 11.5 lakh crores moving to about 17, 18 lakh crores? Our sense is probably it will be a bit slower than that. And hence the tailwind which you saw from a government expenditure perspective may not be there. Now the baton passes on to the corporate sector and the household capex, which is nothing but real estate. And they are coming back, but they are not with as force as the government expenditure was. So clearly you would see a transition which will happen. On the other side, when I look at the social scheme across states and center, that is picking up. Look at day before yesterday on the Rabi side, the MSP side, a clear boost of about 25 to 30,000 crores to the farmer. And then look at the schemes announced for the Maharashtra state election, Haryana, Jharkhand, and then it will be followed up by Delhi and probably UP at some point of time. And our calculations suggest that about 0.8 to 1% of the GDP could be spent on social welfare schemes, which was not the case for a long period of time. And if that happens, money will flow at the bottom of the pyramid. And we all have been talking about a K-shaped recovery in consumption, where the premium end has been doing well, but the mass consumption of the lower part of India has been suffering. I think that can reverse at the margin. And we believe that some of the names out there probably have started to look good. On the headline basis, let me put a caveat. All these names will look expensive. But again, I repeat, if they can deliver 15-20% earnings growth with some kind of a visibility, I think markets would love that, because earnings growth will become scarce as you move ahead in the next 12 to 15 months.
Thank you, Pankaj, for your time. Enjoy your Friday and the weekend, which lies ahead. Now let's